What is the Silicon Valley Bank? What led to its collapse? Will customers get their money back? How will SVB's collapse hurt startups? The banking regulators in the US shut down the financial partner of the innovation economy. As the Silicon Valley Bank, SVB, called itself after it suffered a swift collapse. It has sent shockwaves across the tech and banking industries. Undoubtedly, the bank catered to a very specific crowd of startups, venture capitalists, VCs, and tech firms. But before its collapse, SVB was the 16th biggest bank in the US. Moreover, it is the second bank, after Silvergate, that collapsed last week. It was followed by the US banking regulators shutting down the Signature Bank on Sunday, the third bank to close its doors in a week. Interestingly, it is the second largest bank failure in the history of the US and the first such incident after the 2008 depression. Before this, Washington Mutual Bank had collapsed in September 2008. It had assets worth $307 billion and deposits of $188 billion. SVB, just before its collapse, held assets worth $209 billion and deposits of $175 billion. Started in 1983 in Santa Clara, California, SVB was among the biggest supporters of the tech industry. As of 2021, it claimed to bank for around half of all the US venture-backed startups. Apart from tech companies, it also served media companies like Vox Media. The bank also had deposits from several cryptocurrency firms. Circle said it has $3.3 billion worth of its reserves with the SVB. After the revelation, Binance and Coinbase suspended the withdrawal in Circle's stablecoin USDC. Now bankrupt crypto lender BlockFi also has $227 million stuck at SVB. The bank became a hero among startup founders by lending money even when no other bank did. According to a report by The Verge, SVB lent against the money owed to a business receivables. SVB was known as the go-to bank for investors. In addition to startups, it has also invested in several venture capital firms over the years, including Sequoia Capital, Accel Partners, and Greylock. Before understanding what went wrong at SVB, it is essential to understand the functioning of banks. Basically, a bank accepts deposits from its customers. It then uses the deposits to extend loans to other customers and uses the rest of the money to invest elsewhere. It is done with the assumption that all the depositors will not show up at the bank store to withdraw their deposits at the same time. SVB's collapse came suddenly, following a frenetic 48 hours during which customers yanked deposits from the lender in a classic run on the bank. But the root of its demise goes back several years. Like many other banks, SVB plowed billions into US government bonds during the era of near-zero interest rates. What seemed like a safe bet quickly came unstuck, as the Federal Reserve hiked interest rates aggressively to tame inflation. When interest rates rise, bond prices fall, so the jump in rates eroded the value of SVB's bond portfolio. The portfolio was yielding an average 1.79% return last week, far below the 10-year Treasury yield of around 3.9%, Reuters reported. At the same time, the Fed's hiking spree sent borrowing costs higher, meaning tech startups had to channel more cash towards repaying debt. At the same time, they were struggling to raise new venture capital funding. That forced companies to draw down on deposits held by SVB to fund their operations and growth. Around 1 lakh jobs are expected to be impacted due to the collapse. According to another petition to the US Secretary of Treasury Janet Yellen, SVB has over 37,000 small businesses with more than $250,000 in deposits. They now hang in suspense. channel for more videos.